I'm Borden with MiningIR. We are here in Miami at the first Minds and Money conference in the city. So far, it's been a great time. It's busy on the floor. Joining me is Mike McGlone, Macro Strategist of Bloomberg. Mike, thank you so much for joining me this morning.
Thanks for having me, Tia. It's a wonderful thing to come here. My office, I'm at Bloomberg, is 5 minutes away, and to come to a mines and a mining and metals conference right in Miami. It's way overdue.
A few blocks from you.
Way overdue.
Yeah,
so
you know
good.
what? This is day one, and it's already been buzzy on the floor, and there's a lot of people traveling internationally to be here. I'm looking forward to the next 2 days.
Yeah.
Now, tell me what a macro strategist does.
This is where the market's going and why. So my job 24/7 is, I have to focus on the past a little, but to focus on always a year ahead. This is where I think markets are going. So I'm quite, in terms of mines and metals, I'm big picture, very bullish in metals versus all commodities. Particularly, we all know what's happening with industrialization, decarbonization. But in the shorter term, I'm bearish copper and bullish gold. So that's just, and then I write about that and publish that. In fact, today, which was the 23rd, I just published my metals outlook for the month of March.
Amazing. Now, you mentioned that you typically go to crypto conferences. Why are you here at Minds and Money?
Because because you're here.
Oh,
it's so true. Mm-hmm. We were overdue that for this here in Miami. And I'll go to really what's available. Now this time of year, it's the conference time of year, but Miami's been really famous for cryptos. I go to a lot of those conferences and they can be a little bit unique. Yes. ETFs, definitely this time of year. iConnections, a lot of tech stuff. It's great, but it's good to have the actual mining, the salt of the earth here. And it's 'tis the season too. So, but it's great. I think it's just part of what's happening in America and in Miami. It's all coming here.
Now you're gaining insight from being here. You're hoping to talk to people, kind of understand what the markets are looking like now and for the future. Can you tell us more about that?
Well, that's my main purpose here, just to absorb and listen as much as possible. So it's great to talk. And I'm on a gold panel this afternoon. But for instance, in the keynote speech this morning, the speaker asked, well, who expects the Federal Reserve to meet the 2% target? And I was the only one to raise my hand. I fully expect that we're going to have a significant period of deflation in this country, in North America, in the world, because that's normally what happens when you have a big pump in liquidity and you're dumping. So that's the kind of things I need to hone my views on. Here it's more in the weeds, I like to say I'm the forest guy. I need to dig in with the trees and the weeds here. So I'll dig into supply, ESG. I do enjoy some of these things about mining from outer space, and then I look at this world that would barely scratch the surface of what we can properly mine in terms of minerals and stuff, but it's just absorbing everything I can, and a lot from people like you, from CEOs, from the speakers, and the companies.
A lot of information is circulating. What are some of the trends that you're seeing?
Well, I am fully expecting gold in dollars to break above $2,000 an ounce and never look back. And I'm a little bit more bearish copper in the near term. So I just recently published my outlook, and I did a chart on copper I enjoy doing. If you take the pound per pound price of copper times by 1,000, it's almost exactly as the S&P 500, right about 4,000, $4 per pound. And they've been tracking each other very closely. I fully expect in a normal recession, which we're getting, I think, in this country, based on predictions from things like the yield curve, that S&P 500 is going to go towards 3,000, which means copper is going to more likely head towards $3 a pound. And at some point it's going to break out and go higher, but it's going to be longer term because we have to get through this enduring period. The key thing I focus on a scale of 1 to 10, there's only 110 in the whole world right now, and that's the Fed is still tightening for all risk assets. And it's just number one rule, don't fight the Fed. That was a rule a year ago. Markets are down, the Fed is still tightening. So that to me is what people have to be aware of in the macro. That means copper, industrial metals are more likely to continue lower. On a 12-month basis, the Bloomberg Industrial Metals Index is down about 10%. So that's the trajectory. And what's the economy and markets doing? Fed's still tightening. But gold is about unchanged. So I fully expect gold to break out. But the key thing I'll end with is gold has made a new high in terms of the yen, and it's made a new high in terms of the euro, and it's just a matter of time. I think it's going to do that in terms of the dollar once we see a pivot from the Fed. Unfortunately, that pivot's going to be a while.
Mike, you just mentioned a few things as to what's to come for, I guess, the coming year. What are you most excited about? Are there things that you're looking forward to? Anything that you're curious about that is going to get you excited for 2023?
Well, what I get excited about is I've been nicknamed McGlone because I just point out the facts of what I think is towards a U.S. recession, global recession. But I've been also very bearish commodities, most notably not so much copper so much, but crude oil and natural gas. For the main reasons I'm excited about is it's what I like to say is people are smart, commodities aren't. And that's what we're here to. Miners and people produce more and more commodities at lower cost throughout history and are doing it at the greatest pace ever right now. So that's why the price of natural gas in this country and in Canada, the number one measure of heat and electricity has dropped to the lowest price since 1990. I mean, it's plunged. Crude oil, same price since 2006 after that big pump we last year. That's just what I like to point out is because people are smart, commodities aren't. And that's why it's good you have to know the miners. So I'm excited about human innovation, but I'm more wary about the normal cycles that you have in economies in the world. When you have the biggest pump in liquidity, it's dumping. The history of booms and busts are typically tilting towards a bust. And the key thing is you always never get out of these things until you have massive liquidity pumping from central banks. The key point is most central banks ever are still tightening with the exception of two. Most notable, that's China, because China needs to kind of create more demand, it's having issues, and Japan, both major export countries. The major import country in the world, the US, is tightening and is heading towards a recession. So to me, I can't say I'm excited about it, but I think that's what's happening. And I think what the key thing is most analysts don't get the fact that it's probably going to be worse than most people expect as far as this economic downturn.
And does it get better?
And then it'll get better. But that's the thing, everything will reset better, but you have to get through the pain before the gain, I think. And we're not near that yet. Inflation's going to collapse, and that's typically what it does as, like I said, people are smart, commodities aren't. And metals will probably be the best sector commodities. Historically, metals have been the best performers of all commodities. And here's the bottom line. First of all, we need more of them for most notably decarbonization, electrification, use a lot less fossil fuels, but also it's the cost of storage. Metals are the safest, easiest to store versus trying to store crude oil. It's toxic chemical and it'll always hurt you in terms of futures and rolling into contango and things like that.
Mike, our viewers are investors. Is there anything else you'd like to leave them with before I let you go, perhaps where they can follow your column?
Well, so I'm on Bloomberg and I do publish on Twitter and on LinkedIn. You can link in with me and I'm happy to put people on my distribution list. And the key thing I like to point out when I look at metals, I'm a macro guy, is typically the underlying metal, like a metals index that tracks the metal, will outperform an index that tracks the miners. So when you're an investor, you have to be a little more tactical probably in focusing on, okay, long-term holding the metals, but if you're focusing on the producers, the miners, you have to try to figure out maybe specific miners or producers that do well. But like a broad index will typically underperform. And that's the unique thing about metals. The underlying metal typically outperforms. In energy, it's the opposite. Typically, the price of that crude oil energy will underperform the underlying producers of that commodity. And that's, I think, the key reason is because metals are harder to produce. It's harder and harder to bring on gold. And the other commodities, like fossil fuels, are easier and easier to produce and substitutable. I used to have a farm in Illinois, in Indiana, and a lot of that corn went for ethanol.
Very interesting. Mike, thank you so much for joining me this morning. Mike McGlone of Bloomberg.